Good morning, hunters, and welcome back to the Daily Hunt for Multi-Baggers on this Friday, November 14th, 2025.
That's right, Ethan. We've got a fascinating set of data to unpack today from yesterday's market discussions. We saw quite a surge in user engagement across various platforms, flagging a diverse mix of stocks for our AI to dig into.
Yeah, our AI picked up a good number of posts, and while there's always chatter about potential, the overall sentiment, it leans a bit more cautious today, wouldn't you say?
Absolutely. Our models are flagging a lot of high-risk scenarios, even when there's an optimistic buzz. It's definitely a day for careful consideration.
All right, let's jump right into it. First up, we're looking at Strategy Inc., MSTI. It's a perennial favorite in the community, often linked to Bitcoin movements. Our AI noted a significant number of posts on MSTI yesterday, around 51.
And the sentiment score came in at a deeply bearish -9, Ethan. User complaints were overwhelming, calling it a scam and highlighting a perceived lack of fundamental business value beyond its Bitcoin holdings.
Well, I hear that, but look at the numbers. MSTI actually has a positive net profit margin of over 16% and EPS around $24. These aren't numbers you see from a completely broken business. And Michael Saylor, he's still aggressively bullish on Bitcoin, predicting it'll eclipse gold. That long-term vision, it's a growth story for some.
A growth story with a very high price tag for risk, I'd argue. The current price is barely above its 52-week low. And that debt-to-equity ratio, it's sitting at an alarming 14.147. Plus, a beta of 3.374 means it's extremely volatile. User concerns about constant debt issuance and the stock plunging to its weakest in 13 months, well, they align perfectly with these high-risk KPIs.
It's definitely a high-stakes play, I agree. But for those who believe in the crypto long game, it could be seen as an aggressive proxy.
But for us, focusing on risk-adjusted returns, that level of financial leverage and volatility without robust underlying business revenue growth is a non-starter. Our previous ratings for MSTI have consistently been stay away or speculative gamble, and unfortunately, that hasn't changed.
So, the final verdict for MSTI is to stay away.
Next, let's discuss the Walt Disney Company, DIS. We saw 2 separate clusters of posts yesterday, totaling nearly 100, which is a lot for a company like Disney. Both analyses pointed to a bearish sentiment, one at -1 and the other at a strong -7.
Yeah, but hold on, Brooke. On the surface, Q4 2025 earnings showed some real bright spots. EPS beat estimates, and streaming, direct-to-consumer, actually achieved profitability with a 39% increase. They also added almost 4 million Disney Plus subscribers. Plus, the Parks and Experiences division is growing, and they hiked the dividend to $1.50. They're even doubling their share repurchase target. That signals confidence and value to shareholders, and projections for double-digit EPS growth for fiscal 2026.
Those are certainly positive headline figures, Ethan, but the community sentiment tells a different story. Users are frustrated by the stock price stagnation for nearly a decade, despite constant price hikes on their services. The revenue missed estimates, leading to a 5% pre-market fall and an earnings sell-off. And critically, that debt-to-equity ratio is sky-high at 37.152.
But with the streaming growth and the ESPN Unlimited app coming, couldn't that really move the needle on revenue in the future?
It could, but our current revenue growth KPI is a very low 0.021. The linear TV business is still declining, offsetting those gains. The high debt and low overall revenue growth suggest that the company is struggling to expand its top line sustainably. Users are interpreting the dividend hike not as strength, but a lack of compelling internal reinvestment opportunities. For the stock to genuinely improve its standing, we need to see that growth translate to consistent overall revenue expansion and a clear strategy for debt reduction.
Fair points. Disney hasn't been on our radar before, but the current data just doesn't paint a growth multi-bagger picture.
Correct. The final verdict for Walt Disney Company is to stay away.
All right, moving on to a much smaller cap, APVO Therapeutics, APVO. Our AI picked up 13 posts, and the overall assessment, despite significant risks, leans bullish, scoring a +6. This one's interesting, Brooke.
Interesting, yes, Ethan, but let's be clear, this is highly speculative.
I know, but the post highlights extreme dissonance. Their lead candidate, Miplatomic, showed a 100% remission rate in trials for AML. That's incredible clinical data, clinically de-risking the asset. Analysts are giving it an aggressive valuation with price targets as high as $428. And insiders, 9 bullish purchases versus 0 sales. Plus, they're debuting new TRIS-specific antibody candidates. That's a strong growth narrative for a biotech, if they can get through the valley of death.
That's a very big if, Ethan. While the clinical data is undoubtedly exciting, the financial reality is stark. This is a nanocap company trading at $1.45, perilously close to its 52-week low. Its 52 high was $298, but that was before a 1-for-20 reverse stock split and indicates extreme historical volatility. The company has a net profit margin of 0, negative ROE and ROA, and a sky-high debt-to-equity ratio of 22.942. They're unprofitable and burning cash.
But if they land a big partnership with that clinical data, that changes everything, right? It could bridge that funding gap.
It could, and that's the gamble. The market is currently valuing the significant financial distress over the clinical promise. Without a major financial de-risking event like a lucrative partnership, those financial KPIs will remain dire, leading to further dilution. For most investors, the risk here is simply too high. However, for a sophisticated investor with a very high tolerance for risk, it does present a highly speculative upside.
I think for those with a high-risk appetite, it could be a cautious buy. It's a speculative play on that incredible clinical data translating into a partnership.
I concur, with extreme caution. This is not for the faint of heart. Finally, let's look at Webull Corporation, BUL. Our AI pulled in about 35 posts, with sentiment ranging from bearish to very bearish, scoring -6 and -8.
Okay, but I saw a positive. Revenue growth is actually quite strong at 44.7%. That shows the business is expanding, right? And there's an upcoming earnings date on November 20th. Some users are hoping for an earnings pop, and a few even see it back in the 20 to 30 range eventually. That's some community optimism right there.
Community optimism, Ethan, but the overwhelming sentiment is from bag holders who bought much higher and are now deeply underwater. The stock is currently trading at its 52-week low of $9.01 after plunging from a 52-week high of $79.56. That's catastrophic value destruction. But the revenue growth doesn't matter if it's not translating to profit. Webull has negative net profit, operating margin, ROE, and ROA. It's fundamentally unprofitable and, as users are saying, burning through cash. To top it off, the debt-to-equity ratio is a massive 15.15, signaling extreme financial risk and a high dilution risk. A single earnings pop won't fix this deep-seated unprofitability and leverage. So, despite the revenue,
are screaming danger. Our previous ratings have consistently been stay away, and this data only reinforces that.
So, for Webull Corporation, BUL, it's a stay away.
All right, a quick roundup for our listeners. Here's our compiled list for deeper analysis today. Investigate as buy. None. Investigate as cautious buy. APVO Therapeutics, APVO. Investigate as speculative gamble. Webull Corporation, BUL.
And that wraps up another episode of The Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thank you for joining us. We'll be back again next week to continue our hunt.
Happy hunting, everyone!